Good morning, everyone, and welcome to the Bipartisan Policy Center. And I also want to extend a warm welcome to our virtual and C-SPAN audiences. My name is Dennis Shea. I'm the Executive Director of the J. Ronald Terwilliger Center for Housing Policy here at BPC. We are honored to have as our special guest Federal Housing Finance Agency Director Sandra Thompson. In fact, we are doubly delighted because this is the second time that Director Thompson has joined us for our Leader Speaker series. Director Thompson has dedicated her career to public service, and we want to thank you for that. Before being nominated in 2021 by President Biden to serve as the director of FHFA, Director Thompson served as the agency's deputy director of the Division of Housing Mission and Goals. And prior to her time at FHFA, she worked at the FDIC for more than 20 years in various positions, including as director of the Division of Risk Management Supervision. As many of you know, FHFA is responsible for ensuring the soundness and liquidity of the housing finance system through its oversight of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system, which is just kind of a small job, just the nation's housing finance system, to overseeing it and supervising it. But today we're going to be focusing on the Federal Home Loan Bank system. Today that system comprises 11 regional banks that together manage more than $1.2 trillion in debt obligations of some 6,500 member institutions. These members include commercial banks, credit unions, and insurance companies. The system plays an important role in housing finance as it is designed to provide liquidity to its members to facilitate mortgage lending as well as promote affordable housing and community development. Now, as part of its oversight role, the FHFA recently conducted a comprehensive review of the home loan bank system that was pretty extensive. It involved the participation of some 230 people at listening sessions around the country, as well as 19 regional roundtables, and the receipt of nearly 600 written comments from stakeholders. And I'm getting exhausted just reciting those numbers. 19 regional roundtables. That's a lot of travel. Earlier this month, the agency released its report, the FHLBanks system at 100, focusing on the future. Here's my prop, here it is, and it should be in the YouTube chat for those listening online if you want to access it. But this report was recently released, and it looks at the Federal Home Loan Bank system's performance over the last 90 years, as well as the role it should play going forward. So before we dive into the discussion about the report, I want to first remind the audience that you can submit questions for Director Thompson at any time using the live chat on YouTube, and we'll turn to audience questions at the end of this discussion. And again, thank you for joining us, Director Thompson. So my first question is just sort of a setup question. I mean, your responsibilities are immense. So amidst all these competing priorities, why did you decide to undertake this review of the Federal Home Loan Bank system?
Great question. But first, may I thank you for the opportunity to be here. And I would like to acknowledge our Deputy Director for Bank Supervision, Joshua Stallings, who actually went to all of those roundtables and participated in all those listening sessions. So I do want to acknowledge him and the Division of Bank Resolutions and the Division of Housing Mission and Goals, which worked together to come up with the report. So why do we do this? I felt like it was important that the FHFA have its own informed view on the home loan bank system. We have undertaken many initiatives over the past few years that are topic specific, but we've never done a holistic view of the system, one that looks at both liquidity and affordable housing and community development. And you know this because I think I got a question when I was here the very first time about the role of the home loan bank system. Are they fulfilling the role that Congress established them to fulfill? or are they drifting far away from their mission? And, we got a lot of external feedback. There were lots of articles and concerns that were raised by people whose opinions that I value. And I thought it was important for us to not just respond to some of the challenges and issues that had come up, but to really come up with our own position on this issue. We were coming upon the home loan bank system's 90th year, and we're moving towards 100 years of its existence. And so we thought that this was a good opportunity to really get feedback from around the country, since there are 11 home loan banks around the country, and they're supposed to, provide liquidity and in support of residential housing around the country. Are they doing what they're supposed to do? And how are they doing their mission? And so we undertook this initiative, got lots of input, and really were very thoughtful and careful about how we engage with, with all types of stakeholders, because everyone had an opinion. We also took a look at the last time that a holistic view of the system had been done, and it wasn't done, I think the last one that was done was in the early 90s, after commercial banks and credit unions were allowed to be part of the system. So we thought that the opportunity was right, the timing was right. And to be honest, I had just appointed Joshua as the head of the home loan bank regulation supervision for FHFA. And we brought some fresh eyes and a fresh perspective to this review, because I wanted to make sure that we were balanced in our perspective and that we were balanced in our approach. So not only did we get, information on the home loan banks, but I had asked Joshua to also take a look inside of FHFA at the supervision and regulatory process to see if there were things that we ourselves needed to improve on or change or just think about undertaking as part of this review. And I'm pleased to say that, based on our review, the home loan banks are well positioned to implement many of the recommendations that are embedded in that report.
Well, thank you for that. I have to say the report is very well done. It is holistic, as you say. It's comprehensive. But one thing I really appreciated about it, it's readable. I think even a layperson, someone who's not sort of steeped in this, can pick up the report and sort of get the general flavor of what you're trying to achieve. So
if I might, because
sure.
I think that's important. We are really the mortgage finance sector has its own vocabulary.
Right.
You've got LLPA, DTI, LTV, and many people that are outside of this sector don't understand the language. You have to translate and make things understandable and digestible for people who don't do this for a living. And so
Which is most of us.
Yeah,
Right.
no, it's true. And even the mortgage process itself, I mean, when you start talking to people about mortgages, you can start talking. And one of the things that I've learned the hard way is that when we, issue a report or we're having conversations internally, we're talking to ourselves. And so when we looked at that report, and they can tell you, I read that report and went over it at least 100 times. Like, what did this say? Well, what did you mean when you said this? Well, it doesn't say that. And so just think about our audience, because it's stakeholders that are not embedded in what we do every day. And I just think that, common English is just so important in delivering your message. So thank you for that.
No, it's great. So this is an acronym-free zone.
I
Right?
gotcha.
Okay, so, the report, as it's well organized, it covers 4 broad areas: the mission of the system as a stable and reliable source of liquidity; 3rd, housing and community development; and 4, the sort of nuts and bolts, system operational efficiency, structure, governance. So let's, if we could, dive into each of these areas. Let's talk about mission. As the report makes clear, the home loan bank system was designed to provide liquidity to its member banks to facilitate mortgage lending after the Great Depression. So that was 90 years ago. So
Right.
How has the operational environment of the system changed over the last 90 years, and what adjustments would you want to see to the stated mission of
Sure.
banks?
So I think when the home loan bank system was created, it was created and used primarily by thrift organizations who were in the sole purpose of providing and supporting home or housing finance. And when you think about the mortgage industry today and you look at the participants, over time, and it was thrifts, and then it was banks, commercial banks, and credit unions, and CDFIs, and others. But when you take a look at today's members and you look at the mortgage sector, much of the mortgage finance sector or housing sector is not inside the banking system, and that wasn't true, in the 90s. Having said that, the sector's changed, the number of participants has changed, and even when you think about the number of insured depository institutions, insured by FDIC, when you think about 1990, there were a little over 12,000 insured depositories, and now I don't even think there are 5,000. And so when you look at the membership and you look at the activities, there are not very many, if any, thrifts left.
Right.
And much of housing or mortgage finance is outside of the banking system into the non-bank sector. And so when you think about the activities of the members, a lot of that activity has changed over time. And so we are looking at understanding, why was the system created? What was it supposed to do? It was supposed to facilitate, it's supposed to provide liquidity, which it's done, but for the purpose of residential housing. And so there's a dual mission, and it just seems like, and based on what we heard around the country, that part of that mission was subsumed with the first part of the mission. So providing liquidity was probably the most important thing. And we do believe generally that the home loan bank should be a provider of stable and reliable liquidity for the purpose of, residential finance or mortgage finance. They're supposed to be supporting, community development and housing. So we thought it was important to really clarify the mission, to make sure that people knew there were two parts to that mission, providing stable and reliable, they're supposed to be stable and reliable source of liquidity, but for the purpose of housing finance, residential housing and community development. And so those two go together. It's and both, not either or. Mm-hmm. And so I think that the focus, at least for the past few years, at least for the last three crises that I've been in, mm-hmm. has been on providing liquidity. Now, I would say, though, that for many community banks, they do and continue to do both, and they do it very well. And so I do think that, we're trying to refocus the pendulum back to having a more balanced perspective, again, providing liquidity for the purpose of, making sure that we've got housing finance.
Well, thank you for that. Well, I mean, the report touches, this sort of leads to my next question. The report touches upon the bank failures that occurred earlier this year, and notes that some banks were relying on the home loan bank system mm-hmm. Rather than the Federal Reserve as a source of liquidity. And some were doing so because they didn't have agreements in place to be able to borrow from the Fed's discount window. So the home loan banks really became the lender of last resort. So what is the FHFA recommending to prevent a similar situation from happening again?
So you're right. We are working with the Federal Reserve, the home loan banks are working with the Federal Reserve banks to make sure that agreements are in place. And I do want to make just a distinction of importance. Sure. So again, the home loan banks were put in place to provide liquidity. They were not put in place to serve as a lender of last resort. That is the primary responsibility of the Federal Reserve's discount window. When you don't have those agreements in place, then the home loan banks end up being kind of the lender of last resort. And the home loan banks are established to provide liquidity, but when an institution is in trouble or like markets are challenging, then we need to have a process in place where the home loan banks work together with the Federal Reserve banks, they work together with the primary federal regulator and FHFA to make decisions that result in stability in the financial system. As you know, when the home loan banks have collateral, they've got superior liens, they have prepayment fees. If a bank gets in trouble and fails, and these events happen pretty quickly, they happen in rapid occurrence, and there just needs to be a lot of coordination and collaboration between all interested parties so that we can make informed decisions. Like, it can't just be, the home loan bank and the member, especially for a troubled institution. And you have to have conversation with the primary federal regulator who has updated information on the financial condition of that institution. And you also have to take into consideration all available information. Like, you can't have an internet run happening before your eyes and ask for more advances or an extension of the advances. And so we just believe that making sure that the member's financial condition is appropriate, and that if collateral needs to move to the Federal Reserve from the home loan banks, that the agreements are in place, that the lien positions are appropriate, that whatever processes need to take place are in place when you need them, not kind of after the fact, or we're scrambling at the last minute. And so we have been working with the home loan banks and the Federal Reserve banks to ensure that members have these lines that they can tap, that they understand what their credit limits are, that they understand how the Fed's processes work, and that they're testing these processes before they need them, not in the event of a crisis.
So your report highlights the need for a greater focus of the banks on the creditworthiness of their own member institutions. So that's what you're trying to achieve through this.
Yeah, so they do it every day, and they have procedures in place. But the issues really take place when there are challenges with the institution, or the institution is in a troubled financial condition, and everybody needs to come together to figure out what activity needs to take place. Does the collateral need to move from the home loan banks to the Fed? Are the processes in place? Should the member continue to receive advances? Should they get new advances? Should they get extensions of outstanding advances? And so there's lots of conversation that need to take place so that we can make an informed decision for the system. It's my view that the home loan banks are a part of the housing finance ecosystem. That ecosystem includes, banks, it includes credit unions, it includes lots of different stakeholders. But when you have a failing bank, or when a bank fails and the home loan banks have the collateral and they've got the prepayment fees, and they can lend all day and say, well, we haven't lost any money. Well, you can't just have collateral-based lending. You've got to take a look at the financial condition of the member, because if the bank fails, and I know this for a fact after having worked at FDIC for 23 years, and especially as head of supervision, where we had to take failing bank cases up to the board for closure. And so when you think about losses to the fund, those losses get absorbed by other banks, and then it's a bigger ecosystem than just the home loan banks, and we never have a loss. Well, the loss takes place in the system.
There's no free lunch.
There's no free lunch, and the borrower pay. We pay.
Right.
We, the public, pay. And so making sure that we're all good corporate citizens is really important, and that the coordination takes place, the communication takes place, and that proper and appropriate decisions are made with all parties at the table.
Mm-hmm. Let's go to another area of the report. One of the primary takeaways is that the system needs to put a greater priority on affordable housing and community development. At least that's what I read from the report. So what are some ways in which the home loan banks could broaden their role in these areas while sustaining, I know, as a FDI, commitment to safety and soundness?
Yep, absolutely. You got it. Very good. So there's a number of things that they could do, and one thing they could do is expand their utilization of pilot programs or some of the voluntary programs that work so well. These voluntary programs are things that the banks already do, and they are specific to their districts. Like they have things that are specific to their communities, and there's a lot more they could do there. In fact, we just issued some guidance maybe a week and a half ago that talked about our expectations with regard to pilots, because we want to make sure there's transparency there and that the pilots and voluntary programs continue to be done in a safe and sound manner. We heard across the country that there is more that they could do. There's more they could do with the community development financial institutions, or CDFIs.
Thank you for not using the acronym at first.
I listen, I pay attention. There's more that they could do with CDFIs. There's more that they could do in the multifamily space, especially in the small multifamily mortgage lending space. There are opportunities that the home loan banks have to look and expand their ability to help contribute to the housing supply issue that we are currently undertaking. I think the home loan banks have more flexibility in some respects than the enterprises do. There's some activities that the enterprises cannot do because their charter limits them. But the home loan banks, they're in the 11 regions and they have more flexibility. And so I'd like them to be creative and think about ways that they can be helpful, not just to their communities, but to housing supply areas just generally. And I've been to communities across this country in the past few weeks. I think I've been on the road for the past 6 or 7 weeks. And the housing supply issue is very real. Affordability is very real. And we need to put our creative minds together and really come up with some solutions and figure out ways that the home loan banks can do a little bit more to be helpful in providing affordable housing and or community development in their respective communities.
Will FHFA be providing guidance to the banks?
Of course we will.
On how to do that?
Of course we
Okay,
will.
all right, okay.
Of course we will. Everything has to be done in a safe and sound manner. But there's a lot of creativity at the home loan banks, and they know what the members in their districts need. And so we're going to be working together. We can establish, some governance and boundaries and parameters, but the implementation and execution and the ideas are certainly going to come from the home loan banks.
Your report lays out things you can do through supervisory guidance, things that you can do through rulemaking, and things that you can do through congressional action or require congressional action. And one of the report's recommendations is that the 10% set aside for the affordable housing program, that every federal home loan bank is supposed to set aside 10% of net earnings for affordable housing projects, should be at least doubled, as I recall. And I think that's, I see Carol Wayman in the audience who's clapping. And I think that parallels a bill by Senator Cortez Masto. Legislation is required to do that. Talk to us about why you reached that conclusion, about why the affordable housing program commitment should be increased.
Sure. Well, I think that we've looked at the numbers, and we think that the home loan banks can afford to at least double their affordable housing program commitments. And I would say, though, that the home loan bank system right now voluntarily is contributing about 15% of their net earnings to affordable housing. But when you look at, some of the benefits that the home loan banks have that are outlined in the report, like look at dividends that are going to, the member institutions, compare that to the affordable housing contribution. Look at the fact that the home loan banks don't pay taxes. They don't pay federal taxes or state taxes. There's a huge benefit there. There's a huge benefit in the implied guarantee that the debt that they issue has from the federal government. And so these are, people will say that they're private corporations, but these are government-sponsored entities, and they have a public purpose. And we need to ensure that, we are in a huge housing crisis right now from, again, the supply side and affordability. there's a lot that they can do. And we've done our numbers, and we think they can easily handle 20%. Will everybody like it? Probably not. But is it the right thing to do? I believe so, as long as it's done in a safe and sound manner. And to the extent that you have banks that are, challenged to meet the requirement, we can have conversations about that. But we believe that based on the analysis that we've done, that they're easily able to handle that.
Well, thank you for pointing out that some banks, some of the federal home loan banks, I assume, are doing more than the 10% that are required by statute. So it's a bomb, but maybe others are not achieving that. I don't know. But so let's talk about the nuts and bolts of the system. The report suggests that modernizing the governance structure of the home loan banks could save money in operational costs that could then be reallocated to the affordable housing program. Could you explain what changes you think are needed and how they would cut costs?
Sure. So there are operational expenses that many of the banks undertake, and they're similar. Maybe it's something as simple as moving, everybody to the cloud so that there's shared services that can get where the expense is shared amongst the banks, but the access to those systems is still able to be handled by the individual banks. And just taking a look at, what they do, are there ways to promote efficiencies throughout the system where the expenses, which are, pretty high and dependent on the number of members and the number of states and territories that are covered by the banks, those expenses are fixed and they can be pretty high. So when you're looking at activities, whether it's advances, are there ways to really, reduce expenses or just make sure that the system is operating in an efficient manner? Because again, many do the same operational activities. So are there ways to consolidate operations or share expenses for some of the shared services? And I think that those are things that we should be looking at.
Now, each bank has a board of directors. And the report explains how the boards are structured in terms of size and composition. What do you see but then the report also goes into some suggestions for reform. I was wondering if you could describe what those suggestions are and what potential knowledge gaps could be filled if you broaden who could sit on the board.
Sure. So the statute allows for, I think it's up to 13 board members, and more at the discretion of the director. But you've got varying sizes of the home loan banks. For example, you have some banks who cover 2 states and they've got, a small number of members, and you have other states that cover I think Des Moines has like 16 banks and territories because they absorb Seattle. And so when you think about, efficiency, one, is the alignment appropriate? Is it appropriate to have Hawaii and Guam in the Des Moines territory? Maybe, maybe not. And these are the things that we're going to be looking at: alignment and, consolidation. I think we've got the statutory authority to consolidate the system to 8. But we would have to do a study, and the basis would have to be safety and soundness, right? And so just making sure that that's understood, because I don't want the takeaway to be, she's looking to consolidate the system. Everything that we do is going to be based on, a study in the issue and making sure that we're moving in a safe and sound manner for the benefit of the system. With regard to the board structure, so does it make sense to have the same number or minimum number per institution? It depends. There's a grandfather provision in the statute.
Explain what that is.
Well, it requires us to have the same number of board members or the same allocation as existed in 1960. And so that really throws off the number of board members that can participate in one district or one region. And so we'd like flexibility to adjust as appropriate. If we wanted to adjust downward, we'd like to do that. If we wanted to adjust more, I think we have the flexibility to do that. But making sure that we have the right number of board members for each home loan bank, I think that's something that is very important. And so we have asked the Congress, or we're going to ask to remove that grandfather statute provision in the statute. And with regard to I think 50% of the board members have to be members for the most part. And then you can have some public interest directors, and then you have general interest directors. And so we were thinking that, for some of the emerging risks like information securities or AI, or any cyber securities, or even climate, there are emerging risks that are taking place, and you might need expertise. And maybe that expertise resides in your district, maybe it doesn't. But there is a requirement that you have to have, that the board members have to live in their respective districts, which I totally understand. But for some of these specialty fields that are emerging, like AI, maybe there's a lot of information, or maybe you can get it within your district, but maybe you can't. So we're looking at, just from a governance perspective, some of the nuances that are impactful, that have a statutory requirement to change as opposed to regulatory.
I mean, you have a great chart in the report which shows the 11 home loan banks. It shows you how many states and territories they cover, and then how many member institutions are in each district. And as you point out, Des Moines, I think, is 16, but then you go to Chicago, 2, and Indianapolis, 2, and then the number of member institutions varies widely. I think Pittsburgh has 230 some member institutions, and some have several thousand.
Yeah, and it does, and it makes a difference. Like activity, why did we do this? When certainly the home loan banks played a huge role in the Great Recession and also in the pandemic. But coming off of the pandemic, we saw advances at their lowest level. And so what impact does that have on some of the smaller districts with some of that may be restricted? They still have these expenses, but the advanced activity may be limited. So we really need to take a look at that. And so again, these are things that are important, and we felt that, again, these things we can't do overnight, but we're starting already to prioritize, what are we going to do, from a regulatory perspective, like what rulemaking are we going to undertake? What are we going to ask Congress to do, which I think we've laid out in the report, and then what are we doing through regular guidance from a supervisory perspective. And so these things will take time. This report is supposed to be a multi-year effort. But when the person who comes after me looks at the report and they say, well, why did you do that? We're very hopeful that it will outline, here's what the situation was, here are the inputs that we use, here are the things that we use to make these recommendations, and it'll be a roadmap forward. Now, whether they decide to do it or not, that's, a whole different story, but at least our logic will be laid out.
So, I mean, on the congressional action, the report's very clear, doubling the statutory minimum on the affordable housing program, allowing more mission-oriented institutions to participate. If you want to talk about that.
Well, I think one of the changes we asked for was to allow CDFIs and credit unions to pledge collateral from community financial institutions, CFIs. And right now, the statute, the language says that institutions that are insured, depository institutions by the FDIC, can pledge the CFI collateral, but credit unions who are insured by NCUA cannot, and CDFIs cannot. And sometimes they have collateral because the community financial institution has a limit. It's like under $1 billion. I can't remember exactly what the number is, but it's under $1 billion, and they're able to pledge like small business loans and other types of loans. And sometimes their collateral is that of a credit union or a CDFI. And so we thought that allowing those organizations to have the same benefits as CFIs, as banks that are allowed to pledge CFIs. So this is what happens when you get all those acronyms. It's CDFI, CFI, credit unions, and the like. But yes.
But that would require congressional action.
Yes, it would.
As well as removing the grandfather provision dealing with directors and eliminating or making some changes to executive compensation of the
yes, yes.
Yeah, but what are FHFA's immediate plans on the regulatory side, on the rulemaking side?
Yeah, so we're going to be looking at the AHP program to see if there are things we could do to make access easier, to make compliance easier. For example, some of the affordable housing programs, AHP, are they have regulatory relief from compliance if they're part of like another government program. So you don't have, like the AHP usually is a small part of the capital stack, and you may have 4 or 5 different organizations participating. So if you've got a government organization participating, let's say a LIHTC program where you might have a state housing financial agency participating, then we allow them to rely on the sponsor's compliance guidance because they're such a small part of the stack. Are there other sponsors that we might want to consider? We're not trying to make, we're trying to relieve administrative burdens of implementing the program and just looking at ways we can make things easier, make access easier, and make utilization easier for the banks and the participants involved in who's using these funds.
Fantastic. Well, I'm going to just open it up to questions. If you could just say who you are and if you represent an organization, mention that as well. And we have a hand raised here.
Thank you both. Thank you, Director Thompson and Josh and the whole team for really 2 amazing reports, I have to say. So first is this Federal Home Loan Bank at 100 is wonderful. I'm Carol Wyman, Senator Catherine Cortez Masto, speaking for myself. For that report and then the report that came out the next day, the targeted mission report, because both of those together show how much needs to happen on the mission side, right? You'll see that Des Moines has no voluntary programs, Topeka has very little, Atlanta, Indianapolis, Cincinnati have no SECA, CIP. So what do you want us to watch for next year in the next targeted mission report? And how do some of the Centers for Excellence and some of those innovations are going to inform what your regulatory approach is going to be?
Right. So if we use this year as a benchmark, I would want next year's activity to be greater than this year's activity in states that don't have voluntary programs or aren't using, the full range of available programs for the home loan banks. I would expect that every state should have a voluntary program because the need is there. I'm telling you, I have been to very small towns in Texas and Tennessee and other places. The need is there. It's not partisan. This is real, and people need down payment assistance, people need grants, people need access to credit in a safe and sound way. But I would expect the activity to be there in every single state. And I mean, you know this, Carol, I found out in my confirmation hearing that one of the states was not getting their allocation from the AHP. This was a 3-state, this was a district with 3 states, and I don't understand it because it's supposed to serve the communities of all the states in your district. And I can't think of one state that is more important than another. And when we did the roundtable on, and Joshua can tell you this, on Puerto Rico, on Guam, on Hawaii, and some of the outer islands, there wasn't a lot of knowledge of or utilization of some of the programs that the home loan banks have. And that's just unacceptable. They're there for a reason. They're public entities with a public purpose, and we need to do what they were created to do. And so I would expect that activity to greatly increase. And again, safety and soundness, underlies everything that we do. But there's a lot more that we could do. I mean, are the banks, making sure that their members have an understanding of or awareness of all of the programs that they have? Are they working with their members to try to come up with some of these pilot programs? And are they working across the system to try to have a center of excellence? For example, there are, I don't know how many CDFIs that are non-depository, but I'm not sure if there are 68 or 70, but there are 70, and I think a small number, I think it's under 15, have advances. So there are some home loan banks that understand CDFIs. And so what are the things that work? What are the things that don't work? Do we have one home loan bank that's a center of excellence that can do some sort of thing like best practices for the other home loan banks? So on this
They can learn from
particular
each other.
issue, yeah. So, and there are topics that each one of the banks are really good at, or programs that they've put in place that have been really helpful. I think Boston has done something, and I think Pittsburgh on small businesses, and these are voluntary programs. You've got Atlanta and Dallas, they're working on heirs properties. What are some of the lessons learned? What are some of the issues that you've had to confront? What are some challenges and what are some opportunities? How do we share information? Why shouldn't we establish these centers of excellence? Like there's joint liability and responsibility across the system. So that's true. So and they do this, but there needs to be a little bit more focus on that.
Thank you for that. We have a question over here.
Hi, Seth Appleton, co-chair of BPC's Housing Advisory Council, president of U.S. Mortgage Insurers. Thank you for being here, Director. One thing I wanted to ask you to elaborate on, just because I think that it's really been refreshing, is that as a regulator and conservator in the other part of your job, you've had a pretty consistent message or philosophy that access to affordable credit and systemic safety and soundness are not kind of in tension with one another, right? Like that, I think some policymakers always focus on one at the expense of the other, or vice versa. And I think you've really brought a different perspective. And so wanted to ask you, whether it's on the home loan banks or more broadly in your job, why is it so important to be considering kind of both of these things as part of the same equation, or two sides of the same coin at the same time?
So great question. And this is something that I learned at FDIC, and it carries through. We have seen the ills of the past through the Great Recession, where irresponsible lending took place, where people had loans they didn't understand, loans they couldn't afford, banks failed, across this country, people lost their homes. And so when you think about access to credit, you think about those programs that were, no longer available, like the 0% down or whatever, just irresponsible. And so when you have people that have loans they don't understand, loans they can't afford, they lose their homes, servicers lose, investors lose, they have to move out of their homes, move their families. It's not a positive outcome for anybody. And so we can have affordability and accessibility, but it has to be in the boundaries of safety and soundness. We cannot have people that don't have the ability to repay the mortgage that they took out. And so at the end of the day, I think everything that we do has to be based in safety and soundness. But if you go strictly on, never having a loss, or never, making sure that everybody has perfect everything, you never make a loan, or you might make one or two. And so there are judgments to be made, and especially times like today, when you think about, and I get a lot of flack for, LTV, and I'm a firm believer in equity. I'm a firm believer in skin in the game. But when you think about a first-time buyer today, and Seth, you've heard me say this, you think about a $200,000 home. I'm not sure where you can find it, certainly not in Washington, D.C., but a first-time home buyer will need, from their perspective, 20% down. That's $40,000. And let's just pretend like it's in D.C. and it's $300,000.
Yeah.
$60,000. What first-time home buyer has $60,000? Or even someone that's, out of college, been working a while, or been working 10 years. People just don't have that kind of money, but that doesn't mean that they are not able or willing to repay their mortgage. And so, bad credit or actually low wealth doesn't mean bad credit. And I just want to just kind of deconstruct that notion. And I really would like to think about how we live today and how we make decisions today, and some of the old thinking that might need to be thought about a different way. And so when you think about, people having, let's say, 5% down or 3% down, that doesn't mean they're a bad credit. You've got mortgage insurance that they've got to pay for that's not in the G fee, the guarantee fees to Fannie and Freddie. I had to slip that in, but you have mortgage insurance, and they have to make that payment as a part of their monthly mortgage payment. And so think about, everybody doesn't need to be a homeowner. Everybody doesn't want to be a homeowner. But for those that do, what are some of the barriers? And one of the things that we have worked with Fannie and Freddie on is this notion that many renters believe that they do need this 20% down. And so when you look at home prices and the way that they've increased in the past, 3 years, we had 1 year with an 18.5% year-over-year increase. Yeah. Home prices, lack of supply, the lock-in people like me that aren't moving because we've got low interest rates.
Yep, me too.
Right. So you think about these things, and so you've got people that are willing and able to pay. Let's try to use some good judgment. I mean, that's what the mortgage industry is good at, judgment, making, good calls. And so I do believe that, there are responsible ways to access credit while at the same time making sure that you're doing it in a safe and sound manner.
Thank you for that, and great question. I'm going to take one virtual audience question, then we get an in-person question there. But Barry Zegas, who was a former member of the BPC Housing Commission, asks, what process should the federal home loan banks follow in order to determine whether a member bank is sufficiently stable to make advances to them?
So the home loan banks do get reports of examination from the primary federal regulators, and sometimes that information is outdated, but they do have their own, member credit evaluation. They're supposed to do due diligence on their members, especially when they're making advances. And if I don't emphasize any point, it ought to be that just because a member is able to pledge collateral, you still have to assess their financial condition. Just because they've got the collateral, you've got the prepayment lien, the prepayment penalties, you've got the priority lien, that does not divorce the responsibility divorce the home loan banks from making sure that they are doing a financial assessment of those members, period. That's what they're supposed to do.
Thank you. Right over here.
Thank you very much. I'm Peter Knight. I represent a nonprofit, faith-based organization based in Philly, Esperanza. And I'm also involved with a new organization called the Coalition for Federal Home Loan Bank Reform. And I'm not going to use any TLAs, any three-letter acronyms in any of this. But I think it was striking. Most of the input came from people within the system that were well familiar with it. And so we think this coalition will help in getting information to a broader base of interested parties. The report, I think, is really amazing. It covers so many issues that have been out there for 40 years, going back to FIREA, and it whether it's prepayment penalties or working with the Fed or other things. There are at least two references in the report that suggest that large banks could cause the cost of home loan bank borrowing to go up when the home loan banks are issuing a lot of debt to meet really large demand. And then also where you alluded to this with the FDIC premiums could go up later. Both of those things are not in the best interest of community banks. Yet looking at all the information, all the input from community banks was largely the status quo is really the desired outcome. What's your thoughts on can the home loan banks really, how would they go about serving community banks in a better way?
Well, I think I think community banks do a really good job in all that they do for their communities, and I really want to be protective of what they do and how they do it, and so much so that when I think about community banks, again, I think about the number of financial institutions that were in place in 1990 versus what they have today. Much of the consolidation, many of the challenges in the banking industry have been borne by community banks. And in many cases, as you well know, Peter, many of those banks are the only service providers in their respective communities, and to go outside to get financial services, it's going to be more expensive. And there's just something about, the community bank and just having that institution embedded in the community. And so it is with great care that we are looking at many of these changes. And one of the main things that we're going to do is when we make changes or we make recommendations or we look at policy issues, we're going to be looking at the impact on community banks. Is it positive? Is it negative? What exactly is the input? Is it helpful? Is this something that community banks need to be included in or not included in? And so those are factors that we're going to be taking into consideration, because I tell you, it's challenging. I know technology is really good and it's great, but I think that the services that community banks or community institutions, I should say, provide to their communities go well beyond, financial services. They're staples in the communities, and we want to preserve and protect that. So any policy decision that we will make, we'll take that into consideration in a big way.
Now, I think we have one more audience question from the virtual audience. Now, you can look at it. Do you want to answer that?
Oh, sure.
Okay. In terms of ensuring proper conversations, this is from Kyle Campbell. In terms of ensuring proper conversations are being had between federal home loan banks, members, and primary regulators, are too many things kept behind the curtain of confidential supervisory information?
I'm not sure that is accurate, and especially after the March crises. We have a really good relationship with the primary federal regulators, NCUA, FDIC, the Fed, and the OCC. And we talk to them, regularly. And we really talk to them when there is an issue with a bank or another financial institution. I think the communication, things happen so quickly when you're in a rapidly devolving situation. You've got to get on the phone right away. I mean, Joshua has called, many a Friday night saying, I'm on the phone with, FDIC about this, and this is what we're talking about. And he's also on the phone with the banks. And even the weekend in March, he's on the phone with, the Federal Reserve banks. And so when there's a crisis, all silos are gone and we work together. That is true now, and it's been true. And so I think that this crisis, most recent crisis, has really highlighted the need for greater collaboration and greater cooperation and enhanced communication between all of the necessary stakeholders, the banks, us. And when I say the banks, it's the system, the home loan bank system, FHFA, and the primary federal regulator, and making sure that the Federal Reserve is ready and that the members ready to move that collateral if necessary. But I do think at the end of the day, we're all protective of our respective responsibilities, but we have to make decisions that are in the best interest of our country and financial stability. And so, again, whenever there's a crisis, we always try to work together to make sure that we're making the best decision for financial stability for the housing sector.
Thank you. I'm going to take the final question, if that's okay.
Sure.
And it's a little on a different topic. It's about housing affordability. We've seen this incredible increase in property insurance as a result of the natural disasters, the spate of natural disasters. And you have said that, and some insurers are deciding to exit the market completely in certain high-risk areas. And you said this is an issue that keeps you up at night. And I was wondering if you could share your thoughts on that and how FHFA is trying to address it.
Sure. So, we are a housing regulator. Our primary and only collateral is housing related. It's, our collateral is either a house or an apartment. And so these natural disasters or climate issues are very important to us because it impacts the valuation of the only asset or the primary asset that we have. And so when we see the number of climate incidents that cost $1 billion or more increasing, I think there were like 3 per year in the 80s, and there's been 24 this year alone, and the year's not over yet. When we see insurance companies leaving, states and not offering property and casualty insurance, that makes the home buying process, which is already long and cumbersome and arduous, it makes it a little bit longer because borrowers are going to have to look for, alternatives to certain carriers that previously were there and were not. And so we really are very focused on this insurance issue. We're seeing premiums go up, and I'm hearing anecdotally that many borrowers, property taxes and insurance, like it's usually the taxes that are going up. This year it's the insurance payments that are going up, and it's making it unaffordable for many borrowers. And so that's on kind of the front end. When you have an existing policy, then if there's an incident that takes place, you have to make sure that the coverage is there. And what we're finding is that, the coverage may be there, but it may not be for as much as a borrower thinks. In fact, I looked at my own insurance policy because you only look at it when something happens. And so you want to see what's covered, what's not. And so when you think about the enterprises on the front end, they can't buy loans that don't have property and casualty insurance. They just can't. And on the back end, sometimes the servicers are required to force place insurance, and then the coverage is not as much as it previously was. It covers the balance of the loan, but not all of the other things. So you've got reduced coverage at a higher price. And so these are things that are very impactful, and they're not going away. We need to solve this issue. So last week, FHFA hosted an insurance symposium, and we had some of the insurance commissioners because we wanted to talk specifically about flood and property and casualty, but mostly from an impact on the borrower perspective. And we wanted to get people to understand that this issue is very real and it's hitting people's pockets. And so I think that we're going to have another session on multifamily insurance issues in March of next year, and we're working on that now. But this is a very real issue. Premiums are going up. Reinsurers are charging more for the insurance companies because they use them to transfer some of the credit risk. So everybody's costs are going up. Premiums, expenses are going up, and the claims are more than the premiums that are being taken in. The states regulate these insurance organizations, and so it just requires a lot of conversation, and we can't work in a vacuum. We have to work with the insurance commissioners and the insurance companies to try to really resolve these issues.
Well, thank you for that, and thank you very much for your time. You've been extremely generous, and let's give Director Thompson.
Thank you for having me.
You have a lot more work ahead of you, so we wish you all the best, and wish you here at the BPC and everyone in our virtual audience a very happy Thanksgiving. Have a great day, everybody.